Let me ask you something. Are you tired of working your butt off just to make ends meet? Tired of spending your best hours building someone else's dream? Tired of missing out on important moments of your family? Every day feels the same. Wake up, commute, grind, repeat. Your time disappears and your paycheck barely keeps up. How can we break from that? Right now, thousands of people are quitting their jobs, not because they hit the lottery, but because their money works harder than they do. In this video, you'll learn exactly how to build a portfolio that pays you $1,000 a month in passive income. Not someday, not maybe, step by step, starting today. You'll discover how to calculate your number, how to choose the right dividend-paying stocks and ETFs, and how to turn a simple strategy into monthly income you can count on. You don't need a finance degree. You don't need a huge budget. You just need a plan and the willingness to start. This is how freedom begins. This is the passive path. Disclaimer: this might not make sense from the beginning. Remember to watch and re-watch this video as you move along the way. Click the subscribe and the like buttons so that you can find it later on. Are you ready? Let's start. What if your job disappeared tomorrow? Would your bills still be paid? Most people rely on a single source of income, and for many, that source is fragile. A layoff, a health crisis, a recession. Any of these can break the paycheck cycle overnight. That's why dividend income matters. It's money that comes in whether you're working or not. It doesn't care if you're sick or on vacation. It just shows up, consistently, automatically, quietly funding your life in the background. This is how many early retirees stay retired, and how many workers reduce stress because their lifestyle isn't tied to their job anymore. Dividends are not hype, they are real. They are based on real businesses generating real profits. And the best part? You don't need to be rich to start. You just need to understand how dividend investing works and take action. Traditional jobs are no longer as stable as they used to be. Companies downsize. AI is replacing tasks. Inflation is making everything more expensive. But dividends are predictable. They offer you control in a world where most things feel out of control. This is the foundation of income that doesn't sleep. And it's one of the key ways we build financial security on the passive path. Are you ready to stop trading your time for every dollar? Let's build an income stream that doesn't stop when you clock out. Dividends are payments made by companies to their shareholders. When you buy a stock, you become a part owner of that company. Some companies share part of their profits with owners like you. Those payments are called dividends. You don't have to sell the stock to get this money. You just hold it, and the money shows up in your account. Some companies pay dividends every month, some pay every quarter, some only once or twice a year. But the idea is the same. You earn income just by owning the right shares. That's the power of dividend investing. Now let's talk about dividend yield. It tells you how much you earn in dividends compared to the stock's price. If a company pays $5 per year in dividends and the stock price is $100, that's a 5% yield. If you invest $1,000 in that stock, you'll earn $50 per year in dividends. The formula is simple. Dividend per share divided by stock price multiplied by 100. This gives you the yield as a percentage. It helps you compare different stocks easily. But remember, higher yield doesn't always mean better. Some high yields are risky because the company might cut the dividend later. That's why we focus on quality companies, ones with strong financials, ones that have paid dividends for many years. Now here's how dividend schedules work. Some stocks pay every month, some pay every 3 months. If you hold multiple stocks with different payment dates, you can structure your income to arrive monthly. This creates a steady flow of cash. Even though each company might not pay monthly, your full portfolio can. It's like building your own paycheck system, and it works whether you're working a job or not. Dividend stocks and growth stocks are different. Growth stocks focus on reinvesting profits back into the company. They usually don't pay dividends. Instead, they aim to increase their share price. Dividend stocks, on the other hand, share profits with you. You earn while holding. Both have their place in a smart portfolio. But if your goal is income, dividends give you what growth stocks don't: cash flow. That cash flow can be used to pay bills or reinvested to buy more shares. Either way, it's income working for you. This is the kind of strategy we break down all the time here on the Passive Path. Now you understand how dividend income works. Let's go a level deeper into building a $1,000 a month portfolio, step by step. Section 3. Building a 1,000 month portfolio, step by step. Let's break down exactly how to build a portfolio that pays you $1,000 every month. Step 1 is setting your income goal. If your goal is $1,000 a month, that's $12,000 a year. That number is your annual dividend target. Now move to step 2, calculating how much to invest. You need to know the dividend yield of the stock or fund you're looking at. If the yield is 4%, you divide $12,000 by 0.04. That gives you $300,000. That's how much capital you'd need at a 4% yield to earn $1,000 a month. Let's try another example. Say you only have $120,000 saved. You want to make $12,000 per year in dividends. What yield would you need? Divide $12,000 by $120,000. That gives you a 10% yield. But here's the issue. A 10% yield usually comes with more risk. Many quality dividend stocks fall in the 3 to 6% range. So it's better to aim for solid, consistent payers, not the highest yielders. If your capital is limited, you can take a different route. Start with a smaller goal, like $100 a month. That's $1,200 a year. With a 4% yield, you'd need $30,000 invested. Then slowly build over time. This is where consistency matters. Set up regular investments each month. Even $500 a month adds up quickly when you reinvest dividends. It's not about hitting the full $1,000 right away. It's about building a system that grows. Dividends can snowball over time. As your investments grow, so does your income. The earlier you start, the more time compounding works in your favor. Always factor in taxes. In some countries, you'll pay tax on dividends. In others, you get a tax-free allowance. Also account for inflation. Over time, $1,000 may not be enough, so aim higher than your basic needs if you can. Now think about safety. Don't put everything in one stock. Diversify across sectors and companies. This reduces risk and smooths out your income. You also want to look at payout ratios. That tells you how much of their profits a company is paying in dividends. A lower payout ratio means the company has room to grow or maintain payouts. If the ratio is too high, it could be a red flag. Next, check the company's dividend history. Has it increased payouts over time? Did it hold steady during recessions? The more consistent, the better. This isn't about quick wins. It's about building a steady, reliable income that pays you every month. Dividend investing is slow but powerful. It builds real freedom over time. This is the kind of income that funds early retirement. It gives you options, flexibility, and peace of mind. and it's exactly the kind of system we focus on here on the Passive Path. The steps are simple. Set your goal, calculate your required capital, build a portfolio of reliable income-paying assets, stick with the plan. Not all dividend stocks are worth owning. Some look good on paper but fail over time. The goal is to choose reliable payers that can grow your income. Start by looking for a strong dividend history. Has the company paid dividends for many years? Has it increased those payments over time? That's a good sign of stability. Johnson & Johnson is one example. It has increased its dividend for over 25 years. It's in the healthcare sector. It offers essential products. Its dividend yield is around 3.4%. Another example is Procter & Gamble. It sells everyday household items. The dividend yield is about 2.4%. It has a long record of stable payments. Coca-Cola is also a favorite. It has global brand recognition. It currently yields around 3.1%. These companies are called dividend aristocrats. That means they've increased dividends for 25 consecutive years or more. They usually operate in stable industries. They have consistent cash flow. They weather economic downturns better than others. Another name to consider is AT&T. It's in telecommunications. It currently offers a higher yield of around 4.5%. But higher yield can come with more volatility. Always balance yield with safety. Now, how do you find this data? You don't need a paid tool. Go to Google. Type the company name followed by stock price. Click on the company result. You'll see the price chart. Below that, look for dividend yield. It's free and easy to check. Now let's talk about payout ratio. It shows how much of the company's earnings go to dividends. If a company earns $10 per share and pays $4, the payout ratio is 40%. Lower payout ratios mean more room for growth or to maintain dividends in tough times. Be careful with payout ratios above 80%. They may not be sustainable. Also, check the company's overall financial health. Look at revenue trends. Look at debt levels. Make sure the company is profitable. Dividend growth is another key metric. You want companies that raise their dividends over time. This helps you beat inflation and grow your income without adding more capital. Use the company's investor relations page. Look for the dividend history section. This will show you how the payout has changed over time. Now here's the reality. Picking individual stocks takes time. It requires research and tracking. If that feels like too much, there's another way. We'll cover that next. Do you like this personality? Section 5. Using ETFs and funds to simplify everything. You don't have to pick individual stocks to earn dividend income. There's a simpler way. You can use ETFs. That stands for exchange-traded funds. ETFs are baskets of stocks grouped together. They trade like regular stocks on the stock market. Some ETFs focus on high dividend stocks. Others focus on dividend growth. There are also ETFs that focus on certain sectors or regions. They give you instant diversification. They reduce the time you need to research each company. One example is the Vanguard High Dividend Yield ETF. It holds a broad mix of large companies with solid dividends. It's designed for long-term income. Another is the Schwab US Dividend Equity ETF. It focuses on high-quality companies that grow their dividends over time. It has lower fees and broad coverage. A third option is the Global X Super Dividend ETF. It pays a higher dividend yield, but it also comes with more risk and volatility. Always check what's inside the ETF before investing. Each ETF shows its holdings on its official website. You can see which stocks it owns. You can see how much each sector represents. This helps you understand what you're buying. Now compare ETFs with mutual funds. Mutual funds are also baskets of stocks, but they only trade once per day. ETFs trade all day like stocks. Mutual funds may have higher fees. ETFs usually have lower expense ratios. That means you keep more of your returns. Expense ratio is the fee you pay to own the fund. It's expressed as a percentage. If an ETF has a 0.06% expense ratio and you invest $10,000, the annual fee is $6. It's small, but it matters over time. ETFs make dividend investing simple. You don't need to track dozens of stocks. You just pick a fund that aligns with your goals. It gives you access to hundreds of companies in one move. And many ETFs pay dividends monthly or quarterly. You get exposure, you get diversification, you get cash flow with less time and less stress. This approach is great for beginners. It's also useful for experienced investors who want simplicity. If you want to avoid the work of managing individual stocks, ETFs are a smart path. Let's now talk about how to get dividends every month. Getting paid every month is possible with dividends, but it takes planning. Not all companies pay dividends monthly. Most pay quarterly. Some pay only twice a year. A few pay monthly. To receive income each month, you can stagger your investments. This means holding stocks or funds with different payout schedules. When one pays in January, another pays in February, and so on. Together, they cover all 12 months. This creates a steady cash flow. You're building your own paycheck calendar. Start by listing the pay dates of each stock or ETF. Then group them by month. Look for gaps and fill them with other payers. You can also include monthly dividend ETFs. Some examples include Realty Income Corporation, Stag Industrial, Global X Super Dividend ETF. These pay dividends every single month. They help smooth out your cash flow. Be careful not to chase yield. Higher monthly payers sometimes carry more risk. Always check their financial health and consistency. The goal is steady income, not just high yield. You can also reinvest some dividends and take others as cash. This gives you flexibility. As your portfolio grows, your monthly payments grow too. Eventually, your income can cover all your expenses. That's when real freedom begins. A well-structured dividend calendar removes uncertainty. It makes budgeting easier. It gives you confidence. And it brings you one step closer to financial independence. This is how you build cash flow that never sleeps. Now let's talk about taxes and how to keep more of what you earn. Dividends are income, and like all income, they can be taxed. How much tax you pay depends on where you live. Some countries offer tax-free allowances. Others tax dividends like regular income. It's important to understand the rules in your country. In the UK, there's a tax-free dividend allowance. It used to be £2,000 per year. Now it's £500. That means the first 500 are tax-free. Anything above that is taxed based on your income bracket. Lower earners pay less. Higher earners pay more. But dividend tax is usually lower than income tax. That makes it more efficient. In the United States, qualified dividends are taxed at favorable rates, 0, 15, or 20%, depending on your income. Ordinary dividends are taxed like regular income. Use tax-advantaged accounts when possible. In the US, that includes Roth IRAs and 401ks. In the UK, that includes ISAs. These accounts can shield your dividends from taxes. That means more money stays in your pocket. Always keep records of your dividends. Use a tracker or spreadsheet. Most brokerages provide annual tax forms. Check the forms before filing your return. Missed dividends can lead to penalties. Double taxation can also happen if you invest in foreign stocks. Some countries withhold tax at the source. You might be able to claim a foreign tax credit. or reduce the withholding using a tax treaty. Speak with a tax advisor if you're unsure. It's better to plan ahead than to fix mistakes later. The good news is, dividends are one of the more tax-friendly types of income. Plan your withdrawals carefully. Combine dividends with other income sources, and always keep your tax situation in mind. Now let's talk about how to grow that dividend income faster. Section 8. Growing the income, the compounding effect. Dividend income can grow over time. The secret is reinvestment. When you reinvest your dividends, you buy more shares. More shares mean more future dividend. This creates a snowball effect. It's called compounding. You earn income on your income, and over the years, your portfolio grows faster. Use a dividend reinvestment plan, or DRIP. Most brokerages offer this automatically. It takes your dividend payments and buys more shares for you. No extra fees, no manual effort. It's automatic growth. Let's say you own 100 shares. The company pays you $200 in dividends. You reinvest that $200 and buy 2 more shares. Next year, you earn dividends on 102 shares, then 104, then more. Even small amounts make a difference over time. Compounding works best with time and consistency. The earlier you start, the more powerful it becomes. Next, focus on companies that raise their dividends. This is called dividend growth. Some companies increase their payouts every year. That means your income grows even if you don't add new money. Look for companies with a history of increases. This helps protect your income from inflation. Combine dividend growth with reinvestment. Now you're building a rising income stream. Stay consistent with your contributions. Even small monthly investments add up. Don't stop during market drops. That's when you get more shares for less money. The lower the price, the higher the yield on new purchases. This improves your overall income rate. Avoid pulling dividends too early unless you need them. Let them grow first. Give them time to build strength. If your goal is early retirement, this strategy works. You're not just chasing stock prices. You're building income that works in every market. Ups, downs, sideways. The income keeps coming. This is the strategy we follow on the passive path. Simple, steady, powerful. Now let's cover the habits that keep you on track. Success with dividend investing starts with mindset. It's not about quick wins. It's about long-term consistency. The best investors are patient. They understand the power of time. They don't panic when the market drops. They focus on income, not headlines. They stick to the plan. They avoid distractions. They invest on schedule, every month, every quarter, without trying to time the market. They track their income. They know which companies pay and when. They review their portfolio regularly, but they don't overreact. They stay informed. They read earnings reports. They check dividend announcements, but they don't chase hype. They diversify across sectors. They don't rely on one stock. They balance risk and return. They keep their expenses low. They reinvest when they can. They take profits only when needed. They adjust slowly, not suddenly. They know the goal is income, not just growth, not speculation, just steady, reliable cash flow. They use tools to stay organized. Spreadsheets, apps, brokerage dashboards. They keep records. They prepare for taxes. They protect their capital. They learn from mistakes. And they never stop learning. They stay calm. They stay focused. They build wealth one dividend at a time. These habits separate those who hope from those who win. Let's wrap up with a clear action plan. Start by setting your monthly income target. Decide how much dividend income you want each month. Multiply that number by 12. That's your annual dividend goal. Next, choose a realistic yield range, 3 to 5% is a good place to start. Divide your annual goal by the expected yield. That gives you your required capital. If it feels like a large number, don't worry. You don't need it all at once. Start with what you have. Even $500 can begin your journey. Choose your investment method. You can go with individual dividend stocks or use ETFs for simplicity and diversification. Research companies with a strong dividend history. Look for growing payouts and healthy financials. Use free tools to check dividend yield and payout ratio. If you prefer less management, pick a solid dividend ETF. Check the fund's yield. Check the expense ratio. Review the top holdings. Start building your portfolio. Add funds regularly. Set up automatic investments if possible. Track your dividend payments each month. Use a spreadsheet or dividend tracker. See your income grow over time. Reinvest your dividends to compound faster. Adjust your strategy as needed. If a stock cuts its dividend, review your options. Stay diversified. Stick to your plan. Focus on long-term cash flow. Use tax-advantaged accounts if available. Understand your country's dividend tax rules. Track everything for reporting and planning. Stay disciplined through market ups and downs. Avoid chasing high yields. Stick with quality companies and funds. Keep learning as you grow. Read company reports. Watch market trends. Improve your process each year. Your first milestone could be $50 a month, then $100, then $500. Eventually, $1,000 a month becomes reachable. You're building a system, a machine that pays you while you sleep. This is how passive income is built. This is the passive path. If you're ready to start, take your first step today. Choose one stock or one fund. Invest something. Track your result. Keep going. Each move builds momentum. Each dollar earns more dollars. You're not just investing money, you're buying freedom. Let your money work so you don't have to. You've just learned how to build a dividend portfolio that can pay you $1,000 a month. You've seen the steps. You've seen the math. And now you have the tools to start. This kind of income doesn't happen overnight, but with steady action, it can become your reality. If this video helped you, give it a like. Subscribe to the channel so you never miss a new video. Drop a comment and let us know your dividend goals, or share your favorite dividend stock. And if you know someone who needs this information, share the video with them. Help someone you care about get on the passive path. Good luck on your journey. Feel free to explore other videos on the channel. There's plenty more to learn and apply. Thanks for watching. See you in the next one.